everyone for joining us today for What Kind of Loan? This webinar is part of Financial Poise's webinar series, Business Borrowing Basics. You can find out more about this series on slides 7 and 8, which provide a summary, as well as slide 6, which provides a summary of this particular episode and what we are about to learn. We would like to recognize our co-producer, the National Law Review. The National Law Review is a premier legal news website offering in-depth analysis on a wide variety of legal and business topics. More information on our co-producer can be found on slide 3. And speaking of the slides, unlike some other webinars that you may attend, we will not be stepping through the PowerPoint slide deck in order, nor will we be reading from any of the slides. This webinar, like all Financial Poise webinars, will be a conversation that we are so glad that you have joined us with today. That being said, please keep that slide deck handy. I will try to indicate what slides our conversation is touching on as we proceed, and we'll move through the slide deck with you as we address those topics. All right, so now let's meet our fantastic panelists that we have with us on this day. First, we have Phil Buffington. Hi, Phil. Who is a partner in the banking and financial services team of Balch and Bingham LLP. We also have Harvey Gross, who is the president of HSG Services and the executive director of the New York Institute of Credit. And last but not least, we have Michael Weiss, who is a partner at Weiss & Burney, representing privately and publicly held entities in business and commercial transactions. And as you heard, I am Jacqueline Brooks. I am a partner in our corporate practice group of Dwayne Morris LLP. So we do appreciate that you are not spending your time with us today, really to attend infomercials about each of us. But if you are interested, you can find out more about us on slides 44 through 47. All right. So this webinar, as I said, is a production of Financial Poise. To sign up for our great free weekly newsletter, please go to www.financialpoise.com or shoot an email to info@financialpoise.com with the word subscribe in the subject line, and you will be able to get more information on that newsletter. More information about that can be found on slide 51. And for those joining us today, attending it as a live premiere, you can submit any questions that you have via the web portal. If you're watching this on demand, you can submit questions via email to info@financialpoise.com. Just include your name, the question, and the episode number, and we will get back to you with an answer as soon as possible. So with that, we have all of the administrative things out of the way. So let's really get into it. So when we were all discussing sort of, what kind of loan and things that businesses should take into account when looking at what their financing needs are, I thought it would be helpful to think about potential examples of businesses that may have issues where they may need financing. One of them that I came up with is Allison, who is a is a fashion designer, and she has luckily gained the eye of Saks Fifth Avenue, and Saks wants to purchase an entire winter clothing line for about $1 million purchase order. Allison has determined that it will cost her between $200,000 and $300,000 to really scale her operations. That will probably include, hiring employees, getting materials, maybe even looking for more space. So Harvey, if Allison is looking to finance this $200,000 to $300,000 cost to scale, how could she get funds to pay for that?
There are a couple alternative ways of getting it done. The first one is purchase order finance, which is a facility where the most likely she will not get open credit when she needs to purchase goods and labor, especially if she's going to get the goods overseas to import them. So she will need purchase order financing. That is the first step. The purchase order financing isn't more expensive, but it's a way of being able to get the inventory that she'd be looking for a confirmed order that she has. While she's doing that, if she had a trusted advisor, they should advise her to give a consideration what happens to that inventory when it does reach the customer, which is Saks, in twofold. What's going to happen when an accounts receivable is set up because she needs to sell them on terms, and how long is it going to take them to pay her back? So what is that accounts receivable going to cost her while she's waiting? And also, how good is Saks on a credit check basis? And that's where factors could come in, where they would buy that accounts receivable and possibly even buy the risk on Saks. So the purchase order finance company that she would go to, if this all went proper, would work with a factor and they would enter into a tri-party agreement, and they will all work to accommodate her for the inventory purchase and then the receivable sale. That's the way it's mostly done. There are some factoring companies that will also open up the purchase order finance and do both.
Hmm.
So that is a possibility too. But those
Okay.
steps is something she definitely needs to do. Otherwise, with her own capital and expertise, she will not be able to accomplish what she's looking to do.
And what, other than obviously in the fashion business, that would be something she may look at. Are there other types of business that may look at purchase order financing?
There's all sorts of industries that purchase order handles. Many of them are supported through imports. On domestic, many times there are open credit that's given on a domestic basis. So it could by step the actual purchase order finance. And this way you pay back your trade supplier on terms. That's the way business was several years ago before the imports took over.
Okay. All right. So let's bring in some other types of businesses here. So Michael, let's talk about, maybe one of Allison's friends who has decided to start a new restaurant, and let's call him Bruce. And Bruce decides to bring on, another party, another friend, to join in the business with them, and wants to give his friend Rob a 49% ownership stake in the restaurant. Rob would really like to be a co-owner of this business, but like many people starting out in a small business, he doesn't have the full 200,000 that Bruce is looking for. He only has about 50,000 saved. What would Rob be able to do to get this 150,000 to try to join the business, Michael?
Well, Jackie, thanks again for including me on the panel. Great to be here. There are a couple different financing options that Rob would have. It's what I would call a traditional loan. And if want to have a traditional loan, you have to show from a very high level, a bank, any other type of lender, some type of collateral, and or way to pay back the loan. Because your lender, very essence of borrowing and lending, wants to be sure that they will be paid back. So from a level, we sort of look at two kinds of loans. One based on assets, asset-based lending. So let's say Rob may not have the cash right now, but Rob has, I don't know, you know, $5 million of unrelated real estate or so. So Rob can say, look, I would like to borrow against these assets that I have, and take Mr. Lender, please take a security interest in these assets. And should I not pay, should I default on the loan, you're more than covered. You can liquidate the collateral, which we all know lenders don't want to do. But there's asset-based lending where a lender is strictly looking at what the collateral is, the assets, and how easy they are to liquidate or monetize in order to satisfy a loan. Um,
And in that
and
instance, they would take like a lien essentially on whatever property.
Exactly. Yeah, they would follow the rules of taking a lien, which is a mortgage if it's real estate, or a financing statement, which I won't get too deep on, which is a lien on personal property or intangibles. Let's say Rob just has a huge stock portfolio, but for tax reasons, maybe he doesn't want to sell. Or he owns a couple other privately held companies. So um, collateral could be all sorts of different things, and a bank will look at that. But then let's say Rob doesn't have any of that. Um, Rob may say to the lender, "Well, I don't have the assets to support this loan, but boy, this business is really doing great. And if you loan me the money, we're look at these financial statements and look at this cash flow. I'm going to easily be able to pay you back." And a bank may say, okay, we like this business. We see the great cash flow. We believe you. We trust you. So and often a bank will do a combination of you know collateral and some cash flow loan. We will loan you the money based on this cash flow. We may take a security interest in your stock. If for some reason you don't pay us and the company's doing well, we want to jump in and be able to access that cash flow. So there's a possibility that Rob may end up pledging his shares of stock to the bank. A bank just wants to feel comfortable using that word in the business sense, that it's got some collateral in agreement. And usually on a first loan like this or a loan like this, I mean, Rob will be the borrower, or if Rob has a separate company, investment company that he does deals with, a bank will usually ask for Rob's personal guarantee and say, "Look, Rob, we want you because we're looking at you." And banks, this could be a whole seminar. Ask for personal guarantees for security. Some of it's psychological. They want a borrower committed to a transaction. So there's some flexibility depending on the assets Rob has and how successful the business is, and so forth.
Makes sense. So the bank wants to make sure that Rob essentially has some skin in the game as well, and is serious about
So
it.
Jackie, I just like to jump in on that, and Michael laid it up very well. There are three types of personal guarantees that the lender could ask for. One is an unlimited guarantee, which means you owe everything if anything happens. Two, a limited guarantee that'd be an amount set aside. And the third is what they call a validity guarantee. As long as you don't pull a fraud, we won't go after you personally. So those are the three types of personal guarantees that are out there.
Yeah,
Definitely. And I know later on in the series, we'll likely be talking about much more into the personal guarantees. Michael?
yeah, no, thank you, Harvey. Yeah, absolutely agree. And as financing grows and gets more complicated, and depending on the type of assets, guarantees and limits and what we lenders and finance lawyers like to call carve outs become very complex, very negotiated, and so forth. The tension is um, the borrower or the individual never really wants to guarantee anything, and the bank wants the individual to guarantee everything. So there's always sort of that tension, because the individual doesn't necessarily want to have a personal financial statement with "I have all these guarantees all over," because that can affect his credit going forward. So we start simple, but I think even a viewer can tell that as it grows and businesses grow and multiple businesses, it could get pretty intricate after a short period of time.
And I think Michael really set it up right. And in the eyes of the lender, sometimes asking for the personal guarantee, even though it's just another mark on things that they're supposed to ask for, the feeling is if I have their personal guarantee, they're going to pay attention if something goes wrong and work with me more than it's just, I don't have a personal guarantee, and then I have to rely only on the corporate assets, and they might not focus enough. So you get their attention.
No, that makes sense. Bill, thought you had something to say?
Yeah, Jackie, I want everybody to keep in mind, my experience is, and I think it would be all of ours, is that this is what lenders really are looking for. They're looking for your ability to repay them with the interest that they're charging you for the money that you're using. They don't want your assets. They don't want your business. They want their money back so they can put it back to work. And so all of these structures we're talking about really result in, as y'all so what's aptly put, skin in the game to make sure that you're going to pay us back. So at the end of the day, you've performed, we've performed, and everybody's happy and we're moving on.
Definitely. Definitely. So let's say that Rob was able to get that loan because he was able to put whatever they needed up. And it turned out great for Rob and for the bank. The business is doing great. The restaurant is doing so fantastic that now they have 3 locations and are looking to continue to expand. So while the cash flow is good, they're not really able to still sort of self-finance this expansion. So Phil, what would Bruce and Rob's options be to try to finance another location?
Well, your 2 primary options there are going to be either borrow the money, debt, or raise capital and have a capital infusion. Now, there's a chart on page 10. I'm not going to get into that as much, but you know, some of the pros and cons of those, if the people are looking at it on an equity raise, arguably you will have increased liquidity if you sell stock. And I have to say arguably, because that's not necessarily true if it's a closely held corporation. You will have some partnerships there that you'll have to deal with. They will be strategic because they'll be owners then. You know, the biggest downside of that is your ownership is being diluted. So if they sell more stock and they're at 51.49 and they sell 25% of the stock, I should have run this number. I can't do it in my head. Their ownership will be diluted. And at that point in time, maybe that's not that big of a deal because the 2 of them would still own a majority of the company if you sold 25% more stock. But if they don't agree, then that 3rd person that's coming in may be the person that joins up with either one of them to control the company. And that's more of the outside influence and control. You know, from a debt standpoint, again, as a general proposition, it's going to be less expensive. That's if you've got the ability to go to traditional lenders. If you've got to go to a specialty lender because you're leveraged already or the cash flow isn't there, that may not be necessarily true. You do keep the ownership interest as it says here. But part of what I want to talk about is, too, what you've got to look at. And there's no one easy answer. And it may be a combination of the 2. But if you're going to look at debt, you've got to make sure, and in our scenario, we're talking about cash flow being great, but we're not strong enough to self-fund ourselves. Well, the fact that cash flow is great, and I think that's what the thing was. Yeah, cash flow is great. I want to make sure that's a plus for us because that's going to be a real incentive for a lender to come in and loan to you. And so you've got to look through what all of the strategic options are in that loan, because anybody that's lending you money on the debt side, they're going to have financial covenants. They're going to have ratios that they want to comply with. You're going to have to make sure that you're going to be able to do everything that they want you to do in that loan agreement to get that expansion. And if you can't, then that's not a good option for you. And you'll really need to back up and look and see whether or not the business can adjust to the stress of having to pay that debt and still move forward. If they can't, then an equity option may be your only other option. to be able to go forward. From that standpoint, again, you've got to look at each transaction. There's really no one answer here. It's really fact sensitive to your business. What can your business stand? What are you willing to give up? What is your risk appetite? And look, they're always, and I'm not going to get into it, but we've got all of us could throw up a long list of alternative lenders. I'll throw up one, maybe an SBA loan that comes in. I won't get into the details there, but there's all kinds of debt instruments that you can go out there with. There's also all kinds of equity interest, but I won't get into that. You know, you've got common preferred stock and you've got capital notes and all of that stuff, but we won't get into that in detail. But you've just got to explore it and see what your options are, see what the business can sustain, and really see what your risk appetite is and what your long-term goals are as far as ownership.
I think
Definitely.
Phil, Jackie, I think Phil laid that out very well. And if you look at this chart, I think it does give a lot of information. I think what anybody who's listening to this webinar should know, just like when you go to a financial institution, you want to go to somebody that has history on how they handle their clients and the expertise that they have and how they work with clients. It's very important. That's why trusted advisors is so important, because they can steer people to the appropriate lender. The same goes for equity and debt. If you're talking about family and friends, it's a little different. But if you're talking about going to others, you have to know what their appetite is and what their history is. There have been barracudas that have come in to buy into businesses, and they basically do it to take the business away and put all sorts of roadblocks on so that they can have control of the business. And that's why you really have to know who you're dealing with. And it's not something you can just look in the yellow pages for. It's something you really have to have somebody who knows the industry could give you guidance,
I
like a
agree with
trusted
that.
advisor.
And I think it's important for me to take a pause here to remind everyone that all of the advice that we are giving today is our general advice. This is just for this informational purposes. It is highly important for you to talk with your own attorneys and other advisors on your fact-specific situations as you go forward.
Yeah, and Jackie, just one last thing on the chart. I agree with what Harvey said. I really, but the chart really gives you these options at a high level. There are so many subparts of each issue on this chart that you really do need to make sure you have somebody helping you work through these alternatives. Unless you're fully sophisticated, and then at that point in time, you probably aren't listening to us. But do keep in mind that if you really don't understand all the pros and cons, make sure you've got somebody that's helping you walk through this so you do fully understand the consequences.
Definitely. And Phil, you had mentioned, SBA loans. So Harvey, can you tell me, I have heard people tell small business owners, like, you should get a small business loan from the SBA. Can you speak a little bit too about sort of what those are and the process for that?
The SBA Small Business Association has goods and bad parts to it. The good part is the rate that they charge is reasonable because it's basically through banks. So the rate is reasonable. The problem is they take a lot of time to approve a loan. And if you went to an alternative finance, which Michael mentioned before, they work a lot quicker. They're more expensive, but they work a lot quicker. So depending on your time element, SBA could be very, very appropriate. But once again, if you need it quicker, they can't do it. During COVID, it was issues that SBA was having trouble doing it, and alternative finances actually stepped in. And many of my friends in the industry, they went to and pitched it that we'll give you the money and get taken out when your SBA request is approved. So it was like a bridge loan. And that was pretty proper during COVID. It happened a lot. It's not as much today, but I'm hoping I'm hitting the nails on the head of what you're asking about.
No, definitely. And I think we have a little bit more on sort of SBA loans in our slide deck on slide 18. But also one of the things I think I'll point out for the SBA loans is oftentimes some people think that you need an SBA loan without providing any collateral, and that's not necessarily correct. A lot of times you will have to provide either personal guarantee or other collateral as well, as you would with other financial lenders. So always something to keep in mind.
It's true. You have to have better financials, and you also have to give your personal guarantee. But the benefit is you'll get a deal that's better rated as far as interest.
Very true. Very true. So let's stick with Bruce and Rob. I like their restaurants. I'm a foodie. So they have picked out an empty lot for their next location. And they just need the necessary capital now to build out that location. Michael, what do you think their options would be for that build out?
And Jackie, I mean, it's great to be a foodie. And I have many friends and many clients in the restaurant business. I think it's universally known that the restaurant business, from a business standpoint, is a very tough business. In many cities or small towns all over, restaurants are opening and closing all the time. Restaurants are actually hard to get financed in many ways because the banks are smarter than everyone too, and the banks know that the restaurant tastes go up and down. And especially, and I'm setting the stage for kind of all the problems, and then we'll talk about solutions. Banks or even other lenders, well, there's other lenders, what I would call startups, and I'm putting that in quotes, are always the toughest to loan to. If you have an existing company with existing cash flow, that's easy. A bank sort of understands, hey, here I am. Or if there alternatively, there's a lot of collateral for, asset-based lending, that's great too. But let's assume, we have an existing restaurant and existing brand, but a new location. And let's assume that Rob and Bruce just don't have other assets or funds. So it's a little precarious. What a bank will look at, what we talked about earlier, are there other assets um, and that Rob or Bruce or any of their companies can pledge or collateralize for this loan. And the lender will also look at what's the cash flow of the other restaurants. So they're building the fifth, let's call it the Acme restaurant. The first four have been tremendously successful. This is a really great location from a marketing study. I mean, it's sort of like arguing your case and making a presentation to the bank from a cash flow, saying, here's our pro formas, here's our PowerPoint, here's our slide deck on how wonderful this is going to be. We actually don't have a lot of debt on our other restaurants, so we can, second mortgage or take a mortgage, so we can provide you with some asset security. Also, look at the great cash flow for the other restaurant. And every time we opened a restaurant, oh my gosh, the night before the opening, people were lining up, waiting through the night, for the doors to open to get reservations. And believe it or not, there are restaurants in Chicago and probably New York, I'm sure, Harvey and Phil, maybe out by you, where you need like 6 months to get a reservation. That's a very rare restaurant. So if our restaurant for Bruce and Rob have been like that, so the bank knows, wow, this is just going to be a success. So there's, the traditional lending of cash flow and asset. There is a concept also called a bridge loan. A construction loan is a little bit of a different thing, because as you start with nothing, a clean slate, and then the end product is a functional commercial building, which is going to be worth something. Hard to repurpose if the restaurant doesn't work, but it's going to be something. A bank may do a construction loan and go through a control kind of the payouts to all the contractors to make sure everything's fair and square. And then the bank may say, hey, we want to be a construction lender, but once the restaurant is built and people are going in and it's cash flowing, our loan expires. Come talk to us about a permanent loan or talk to someone else. So as Phil appropriately mentioned, there's all sorts of products and gap fillers and different situations. But the important things and the takeaways for our audience are, have the other restaurants been successful and what other assets are there? Now, if the other 4 restaurants are failing, and Rob and Bruce have no assets and they go to a lender or even an alternative lender and say, okay, those other 4, those were mistakes. Those were not in good areas, but this one's a winner. Well, a little bit of a tougher sell there. For a lender. But there's a few different options, and success sort of breeds success. So hopefully their business is going well. I will add, and from a global standpoint, as Phil said, which is so right, banks just want to get repaid. And banks love winners. Alternative lenders love winners. When you're doing well, your phone is ringing off the hook from every lender who wants to do business with you and wants to sell you deposit products and so forth. But if you have a problem and you're at default, it's a different tone of voice.
Yeah.
So I think what Michael laid it out very well. So I just wanted to step in on a couple of things. One, he mentioned zoning. First of all, you have to have the zoning to be able to put a restaurant there. And also, if it can't be built as a restaurant, what else alternative would you have? And there are certain times there are handcuffs on that you can't even build it. So I'm sure somebody will be careful about that. I also wanted to address asset-based lending. And the chart shows it well, cash flow worth asset-based lending. So banks have ABLs. So you're not really borrowing from the bank directly, you're borrowing from their ABL side. And that's important to know. And then there are also asset-based lenders who are not bank-owned. And that's where you really stress the cash flow versus asset-based lending, because there are many cash flow guys that are regulated like banks. You really have to be beautiful in order to get your money. You really have to be good financial statements, good history, and all that good stuff. The asset-based lending cheats a little if they have enough collateral. So the alternative finance company that is not bank-owned but can feel comfortable with the assets, they might not be as demanding on P&L and all that good stuff and strength of liquidity. So I just wanted to just point it out. That is the different ways that you do things.
Yeah. Phil, like you were going to overlay something?
Yeah, I do. And look, I know this is beyond the scope of what we're talking about, but I think it's an alternative that really gets back to making sure you get to somebody like y'all that can give good advice. And let's go back to the restaurant and the new location. There's a concept where you may want to separate your business. If I'm an investor, I may be willing to invest in Michael's new location from a real estate standpoint, but not a restaurant standpoint. So separate your business, have your real estate one place, your restaurant was leasing the real estate. So now I'm one of Michael's investors just in the real estate side, not in the restaurant, because restaurants scare me, but I love real estate. And I know he's got 3 good restaurants. I think he'll be able to make a 4th one. They're going to be able to cash flow with their leases. So I'm good with that. So and I know that's a little bit outside the box, but that's what you've got to do. You've got to think about this stuff and then get with somebody that can give you good advice to structure something that works for you. But that could be a good place where you have debt and equity.
Right. That's a good point. And
I'll just, Jackie, I'd like to, I know we're going long on this, but just one last thing too. Some entrepreneurial people are there for the long term and some look for exit strategy. So they might build up a string of restaurants and then want to cash out by going to a big name and have it as different locations and franchises. So it's just different mindset on how long an entrepreneurial person wants to sit with their entity.
that's all why it's very important to make sure you're also, while you're looking at them to assist you, whether it's from a debt or equity standpoint, you're also doing your due diligence on who you're doing business with.
Yep.
To make sure it's going to be a right fit, especially if it's going to be someone that's looking to be around long term. So one of the things that Michael and Phil, I think you talked about was sort of like all the different sorts of gap fillers you may need depending on what comes up. And, you know, in restaurant business, there's always things that happen. So let's say, you know, a freezer has gone out, or, you know, some other, a new stove is needed for the restaurant. If they don't have the cash flow to address that need at the time, what are ways in which they could get funds for that? And I'll give that to Phil.
Well, and I welcome anybody to join in, but really when you're talking about buying equipment, you really got two options. You're either going to finance it through a traditional lender or some kind of lender, or you're going to lease it. And this is my favorite answer of all time for legal advice. When you ask me which one is better, the answer is always, it depends. And I don't mean that sarcastically. It really does depend on your facts and circumstances, your cash flow, your needs, everything that's going on. I mean, again, on page 19, there's some high points about that, and those are great. You know, if you finance the equipment, it's on your balance sheet, you get depreciation, and you go through that whole process. If you lease it, generally it's not an asset because you're leasing it. Your full payments generally tax deductible, as only your interest payments on a loan would be deductible. And then you can buy the equipment at the end of the lease. But the real point here is, what do you need it for, and how long are you going to need it, and some of the options there. And I think ownership and equipment leasing are pretty self-evident. It's yours if you buy it. You've just got to make the payments. Sometimes the financing could be more attractive. Again, that depends. But once it's fully paid for, it is yours. And if after it's fully paid for, you can still utilize it as collateral, as opposed to a lease. It's not going to be yours unless you exercise an option at the end. And that option may be one of two things. It may be buying it at fair market value if the lease payments have been really low. It may be buying it at $1 if the lease payments have really been just amortizing the cost of the equipment plus interest over the term of the lease. So, you know, you've got to look at it. You've got to see what you need from a tax advantage standpoint. But the other thing that you need to do when you're looking at this, if you're looking at a piece of equipment, and I don't know that this would necessarily be the case with a refrigerator, and I'm trying to think of a piece of equipment in a restaurant that would fall into this category. But if there's, let's talk about this. You're going to buy a cash register system that's right at the end of a 3-year cycle, and new systems are coming out. So you're fixing to buy what's ultimately going to be an outdated system. And if you want to stay current with systems like that, you may want to lease that so you can always stay current with the most current equipment and always move forward. You may want to own it, but again, that would be something that you would think about when you decide whether or not to purchase or lease. Is how long you would need the equipment, whether or not it's going to be upgraded in the immediate future, and you'd be stuck with something that's kind of, it's kind of like iPhones. If you have an iPhone 4 now, you're outdated. And so, you know, quite frankly, that's a terrible example from the standpoint of a cost. But if you multiply that times 1,000 and you're talking about a $40,000 phone system, then do you really want the one that's going to be outdated within the next 2 or 3 years without the ability to upgrade? So you've got to take that into consideration. But again, it gets back to what you can do from a cash flow standpoint. I'm going to be quiet there because I know y'all got some things that y'all might want to add into that.
Well, the one thing
Go ahead,
I
Jack.
wanted to mention is, we've been talking about asset-based loans and other types of loans. And so one of the things, which is not necessarily for this particular episode, but you want to also look at what your covenants are if you do have, if this is a gap filler and you already have other financing in place to make sure you're not going to default or breach the terms of that loan.
Yeah, and I will mention one thing, and everybody needs to remember this, like Jackie was talking about, you got to make sure if you've already got financing and they got a blanket lien, you basically got two options. Go to your lender and let them agree to allow you finance another piece of equipment with somebody else, or you got to do a purchase money security interest. And that's all I'm going to say about PIMSs, because that could be a 30-minute conversation in and of itself. But there are some options there, and I would say make sure you go to somebody qualified, like the people on this panel, that could give you that advice on what are your best options to fulfill that need.
So, Jackie, fortunately or unfortunately, restaurants have been a source to get their money from merchant cash advance people. And that's a whole topic to itself. I don't know if you want to address it now or later or never, but they're a source for restaurants to get money. And the usual theory is the way they work. They give money up to 6 months of sales. So if you historically did 100,000 a month, you might get 600,000 based on the future sales that you're going to get. Sounds good, but the devil will be in the details because the interest rates are, and other things are sometimes predatory. So I just mentioned to you, there's certain industries, restaurants has been one of the industries that merchant cash advance has done. And prior to the MCAs coming in around 2008, there were credit card processes, and they functioned by doing the credit cards. So you were bringing them in anyway to do your credit cards, and then they gave you money against the future sales. That really morphed into around 2008 and 9 when the MCAs took that over. And instead of doing it through the credit card, they do it with ACH swipes through the bank accounts.
And I think in the slide deck we have merchant cash advance information beginning with slide 27. And so we will let's circle back to that because I think there are definitely questions that we should discuss more on that. So Michael, I think, as he was talking about the merchant cash advances on which begins with slide 27, I know several states now seem to be trying to, input legislative fixes for some of the issues that Harvey mentioned with people not fully understanding the terms of them, or merchant cash, some companies trying to take advantage of people like, our restaurateurs. What are some of the things that you think people should consider when looking at that?
Well, Harvey hit the nail on the head. And let's use our restaurant example. It is absolutely a very popular way for restaurants or high credit card type of business, high consumer activity, to get cash advance. And in my mind, it's really a kind of factoring, and I don't want to throw around a lot of fancy terms where you're sort of you know getting a cash advance at a certain percentage and pledging your revenue. And what the regulators are very concerned about is, I think they're okay with that. It's just what kind of rates and what kind of fees. And in the business of restaurants, there's a lot of small businesses, a lot of consumers, a lot of first timers, a lot of non-sophisticated big companies. And, it's almost like credit card protection. If the consumers are paying 20, 25, 30% credit cards, it's hard to make a living, it's hard to make a profit. So that's really the biggest concern is a little bit of desperation. How else is there to get money? If you can't get equity, the traditional banks are concerned. Let's say our example of the restaurants, there's just not a lot of cash flow to make banks really satisfied. You have to go to the type of lenders, and those type of lenders, though, also do have restrictions. They want you to be in business for a year. And that's sort of our slide number 29 later. You have to show some bank statements, some statements. I mean, you really have to be at least, but it doesn't take a lot to qualify. And there's a lot of lenders out there that love to put money out in the market at high rates.
Right.
That's their business. So it's a trade-off of protecting the borrower. It's not much different than being a consumer. And that therein lies the tension, Harvey. It's in any type of specialty lending, and I know I'm sort of going beyond what this webinar is. There's a trade-off of lenders being able to do what they want, and borrower protection and consumer protection, and therein sort of lies the balance. And frankly, different states treat it differently also. So, but this is definitely, we're in the world of alternative lending, and that's more expensive than traditional lending.
Yeah.
Bill, you
So
wanted to say something? So I'd like to jump in on this.
please do, Harvey.
Michael mentioned factoring. I've been in factoring 60 years. I've seen it all. But the merchant cash advance is a completely different world. So I'd like to just draw a little line down the middle for people to understand. We talked about asset-based lenders and factors who will ask for financial statements and P&L and what type of character, capacity, and all the 4 C's and 5 C's of credit. And they do it in a science. Once you sign on, basically the agreement is with them. And if you need more than one lender, the lender is the guy that brings in participants. Okay? That's not the case with MCAs. So they come in and they'll take, and I say this because it's something that we have in America, which now is a problem. The MCAs get their business through brokers, and those brokers are called ISOs, independent selling organizations. If you never met an ISO, you're lucky. They are the most aggressive people out. So what they do is very aggressively get an MCA issue done so that that money comes in, and they don't stop there. They go to a second, a third, a fourth, a fifth, a sixth, seven, eight. It's called MCA stacking. And they don't do any vetting out. They just get the people the money. And these MCAs all come in. They're getting their interest rates between 40 and 120%. So the feeling is, how much bad debt can I get? I'm making so much money on these transactions. Nobody's thinking of the longevity of the borrower, giving them any guidance. And they don't enter into intercreditor agreements so that everybody is playing. And then everybody is just grabbing the ACH out of the cash account. They also had a few other things they were doing, and some of the states have gotten into this, but they were working on what was called confessions of judgment. Now, in the traditional sense, when a lender asked for a confession of judgment, it was only based that they would say, okay, I'm taking your keys to the business because you can't handle your business anymore. You're basically underwater, and I'm going to take your business and run with it. These MCAs have had confessions of judgment at any time they wanted, even if the business was still viable. And that became a big problem. The state of New York allowed it for years until Bloomberg wrote a scathing article. And now in New York State, you can't do it with confessions of judgment anymore. So that changed a little. I don't know that these other states have picked up on that as yet. But as you mentioned, Jackie, the feds and the various states are trying to put clamps to these MCA issues. So we in the factoring and the alternative finance business have looked at the MCAs as being a problem. And we are trying in some cases to work with some of these good MCAs to work with them because their due diligence a lot less, they're very quick, and they could save a lot of these borrowers. But unfortunately, there's a majority of them that aren't thinking best for the borrower. They're only thinking how they can make as much money as they can and milk the business dry. So I'll get off my soapbox, but that's what we're all living with right now.
So now that we understand some of the issues that have come about with the MCAs, explain to us, Harvey, you had mentioned factoring. So what's really the process for factoring, and when do you consider using the factoring?
So the factoring is purchase of an accounts receivable. And I use the word purchase. The MCA, they're not purchasing, they're giving money against future sales. It's not a purchase, it's really a loan. And if it's a loan, it is usury in almost any state that has a usury law. So that's one distinction. Now, the flip side, when a factor buys the account, and I don't want to get too technical on what's called a non-recourse, that's a pure true sale because you're buying the asset, the receivable, and you're taking the credit risk on that account, like in the first transaction with Saks. Not only did you buy the receivable, but you also guaranteed the ability of the customer to pay. That's pure factoring. Many factoring companies in the last 20, 30 years became recourse factoring. They'll give you the money, they'll purchase your receivable, but if anything happens with the customer and they go bankrupt or insolvent, it gets charged back to the client. So that's called recourse. There are some people that think that that's a loan. And I've had my arguments with different lawyers to try to tell them I don't believe so. I think a purchase is a purchase, whether it's recourse or non-recourse, and should be considered a purchase and not a loan. And I'll only just throw in tidbits. I don't know if it's a winning argument, but if you look at a balance sheet, a factor is purchasing accounts receivable. So there is no accounts receivable on the balance sheet. It's due from factor. When you make a loan against receivables, the receivable is there and is an offset as a liability where the loan is. So the accountants have put due from factor, whether it's a recourse or non-recourse. And that's my argument for the day. Even though I'm not a lawyer, I'm maybe on television, I practice it. But that's the argument that I would say to a judge if we had to decide whether it was a purchase or a loan.
And that, so it sounds like factoring would come into play a lot of times when you have an account receivable where you may not receive payment on it for, 90, 120, 150 days or so. So you can
factoring started off being in the apparel textile industry. It expanded to electronics. It went to healthcare. It's in transportation. It's in staffing. It's in government and municipal when you sell to the government or the states. So factoring is in a lot of different industries now. And they're even in the construction industry. So certain industries are more prevalent. What we try to tell factors and people in different industries, see what expertise that factor has, because certain factors are very strong in certain industries. Some factors are generalists, but a lot of factors are very strong in the industry that they service. So it's very important to know the strength of the factor. They could be very, very helpful for many reasons. Not only do they buy your receivable and give you cash, but they could give you guidance on the industry because they have a great knowledge of what's happening in the industry.
And we have more in a slide deck on factoring on slides 23 and 26. And so we've talked a lot about how there's all this sort of alternative financing that's available. There are some lenders that are regulated, some lenders that aren't regulated. some lenders that states are trying to regulate. So Phil, can you tell me, like, should I care whether or not a lender is regulated or not? Like, what's that even mean?
Thanks, Jackie. I'm going to bring together 3 topics, and I'm going to do it real quickly so everybody else will get a chance to weigh in on this. When we talk about regulated versus non-regulated, a lot of times what we think about are banks versus fintech lenders. And I'm going to stop there. Then we start talking about fintech lenders, which really are regulated even more and more so by a lot of state laws. And then we've got a lot of other issues of who originates the loan and who services the loan. And then you come back into the point that when you talk about fintech lending, really what you're talking about in some instances are platform lending, which some banks are getting into. So it kind of skews the whole conversation. And I think what I could say here is this. You need to make sure that your lender is licensed. I think those are the best lenders to deal with, whether they're banks or fintechs. Make sure there's some regulatory aspect to it. They're different. You've got the FDIC insurance, you've got the credit union insurance. You don't necessarily have that with fintechs, but you always have the consumer laws that are overlapping there. We're talking about business loans here. So you do have some of the business type arrangements that are requirements for regulated and non-regulated entities. And the best thing that I can tell people is know who the lender is you're dealing with, because every lender that you want to deal with is going to have some kind of regulatory oversight. The question is going to be how much, and how much or how little they have will dictate to some degree how flexible they can be in meeting your request for a loan. For example, a traditional bank is going to have to go through a lot more from the standpoint of compliance issues than maybe a fintech lender. But again, it depends on where the fintech lender's licensed and what they may have to comply with too. But they would probably be a little more nimble, maybe more user-friendly. A downside would be, and some banks would tell you this, with fintech lenders, you don't have that personal connection, that person you can go see that can help you with the transaction that you can deal with. You're just dealing with somebody on the phone. In today's times, I don't know that that's necessary, but you do need to know what lender you're dealing with and know that they are reputable and that you can rely on what they're telling you and you are getting a reputable product.
So I'd like to just jump in on this, the difference a little between regulated and non-regulated. Some of the major factors who are not banks have told me that they still consider themselves regulated because they get their money from big banks. So basically, the banks want them to operate as if they were regulated. So you could feel comfortable if you're dealing with a bank or a real larger factoring company. There's several of them in the country that do in the billions. They're like considered to be regulated and they operate that way. Also, private equity and hedge funds is not regulated. So there are sometimes you have to consider, is that a plus or a minus? My experience has been, and I'm not going to say it means anything, but people should know, if you're regulated and the borrower does something nasty to the point that it borders on fraud, you have to blow a whistle, and that regulated source cannot continue to handle it in a normal way. That account has to go into what they call an SAR, a special accounts receivable, and somebody from the feds actually comes in and works with the financial institution to get this thing resolved. If you're not regulated, you don't have to go that way. I've been involved with many seminars where the subject comes up. You have a borrower, they pulled something on you. What is your responsibility? And there are many lenders that'll say, my responsibility is to get paid and everybody else has to worry about what they're going to do. And We've had DAs talk about it. We've had the feds talk about it. And I'm talking about serious situations when somebody has done something dastardly. So that's where regulated and non-regulated really come in. So for a borrower's point of view, if you're going to be legit, you of course would love to be with a regulated source, but and get a better pricing, but you're going to have better makeup on and look a little better.
Yeah, but and Harvey, to add to that, and again, I know Michael and Jackie may want to add something, but there are state laws that would be applicable to just about any company out there doing that. Privacy laws, there could be some discrimination laws that would be applicable to all of those companies across the board. And a lot of that could depend on how aggressively an attorney general wanted to be for the state that this activity was taking place in. But again, if you're crossing state lines, you really have to be careful with, and again, it gets back to, I agree with you. And let me give you this example. You said that about factoring people. You could have a finance company that had a line of credit with a big bank, and what they've got is they can get higher rate loans, so they can borrow money at 8% and loan it out at 16. So they do have the problem of dealing with their lender, but they're also going to have some regulatory oversight. And I know we talked about this in our, I know we're at the end, but we talked about this in our session. You know, there's so many states that are being proactive with all types of lenders. You really have to look at the state law and make sure that you're not participating with a lender that's running afoul of some state law that you end up having to deal with as a borrower. And they're just, with 50 states, in some instances, there are 50 thought processes there. That's a ridiculous example, but y'all get what I'm saying. You really do. You've got some that are somewhat conservative, some that are more open to any kind of arrangement, and then the groups in the middle. And you just got to be careful with that whenever you're doing anything trying to borrow money for a new business. First of all, new businesses don't have a real history of being successful statistically. And what you don't need is somebody that's supposedly helping you making that more difficult.
So
So very true.
we just did along the lines what Phil's talking about. I had a seminar last week and we talked on disclosure laws. Different states have different disclosure laws. So one of the attorneys who made the presentation, actually, we didn't give it out at the event, but we emailed it to them. It shows you the United States of America and the different states and what their different disclosure laws are. So that was very important. I'd like to just go back, and Michael could join in if he wants, but I'd like to just address the code of ethics. There is a story in code of ethics when you're at a financial institution. When you have a problem, how do you discuss that if somebody calls you up and asks you? So the theory is if you just give the facts, the actual pencil plus and minus, you're safe. Once you put dictatorial to it, that's different. So and there are banks, if they have a problem, they'll say to somebody, put it in writing, your request, and then they make sure their legal department reviews it and they decide whether they want to answer or not. So the code of ethics does filter in on how you handle it when you have a problem. I know financial institutions over the years have given out what I'll call phony stories so that people put new goods into their client so they can get out of the account. And that's a no-no, but people have done that. I'll turn it over to you, Michael.
So I will say, at the end of the day, it sounds like, especially because there are various types of alternative lenders, various types of traditional lenders, the one thing that I think sort of runs throughout the thread of our conversation today is make sure you have a good advisor that can walk you through what those lenders are required to give you. Make sure you're doing your due diligence on the lenders to make sure they are reputable and are not and are following sort of whatever the regulation, license, and disclosure requirements may be. But it can be very complicated, very fact specific. So make sure you have good advisors that you're working with. And with that, I will thank all of you. Thank you, Harvey, Phil, Michael, for your time today. Thank everyone for listening. I know we're a few minutes over, so we thank you and have a great afternoon.
Thank you, everybody. Good job.
Thank you.
Good afternoon.